Good afternoon. My name is David Jarvis, and I'm President, CEO, and founder of Corton Capital. Corton Capital is an asset management firm that specializes in traditional investments and alternative investments. Our goal is to create comprehensive portfolios for investors by marrying up both traditional and alternative investments for you. What follows next are a series of presentations and comments by various managers within the Corton family discussing the performance and successes that they've experienced with the funds that are carried within the Corton family. I hope you find it informative and we look forward to working with you. We are here to work with you and create comprehensive and interesting portfolios for you. Thank you very much.
Welcome to another edition of the Corton Aemelia Quant Fund podcast, where we try to take the emotion out of investing. As usual, we'll start with the disclosures. I'm Mark Deriet. I'm the founder of Aemelia Capital Management Corp, an independent firm that develops quantitative models that have been licensed to and implemented by Corton Capital Inc. Corton is the investment fund manager and portfolio manager of the Corton Aemelia Quantitative Fund and its underlying fund, Corton Aemelia Quantitative Fund LP, each a related issuer of Corton. This is my mugshot in case we've never met in person. It's pretty rare that I'm wearing a tie, believe me, but that's what I look at, my smiling face there. So lots to go through in the markets. There's a whole lot of things going on at once, it seems. And if we step back and just look at our green lights and yellow lights and red lights and so on, there are no red currently, thankfully, but there are a number of yellow lights flickering. So we will discuss those charts in particular. We want to start with Friday's big down day. So this is the S&P in black and significant down days overlaid with the blue bars. And by that, we mean more than 2 deviation event in any given day. And that is 2.2% to the downside. Friday was 2.6, so it qualified, unfortunately. And nothing's perfect, but these often do kick off bigger drawdowns historically. So the table below shows the average drawdown 1 month all the way to 12 months, 6% for 1 month and 15 for 12. It doesn't have to occur, obviously, and sometimes these things happen at a low, but it's a definite change in character from the strong snapback that we saw off the March 30th bottom. So we have to stand up and pay attention. These are the details of every initial big down day since 1970. And you can see it caught some of the doozies, the 87 crash. After that signal, the following month fell by 30%. COVID, the signal came on February 24th, and the month after we were down 31%. So our key thing is to try to avoid these big drawdowns, and we have turned much more defensively based on that signal. Again, it doesn't always occur in a bigger drawdown to come, but the averages are on your side. And there are a number of things that are sort of odd in this market, I would say, and not confirming the strength that we've seen in the S&P. So the first chart here, the red line is the price of junk bonds, and the black line is the S&P. And typically off of a major turning point, a low, the price of junk bonds has a very significant rally along with the S&P. And you can see that's not the case now. It's a pretty tepid rally off the low. So the credit market is not as exuberant as equities. That always gives us a pause for concern. Here we show the red line is triple C spread, so the riskiest of junk bonds versus high yield spreads in blue. And the triple Cs have started to widen significantly, whereas the blue line, the high yield, is still fairly subdued. The last time we saw that, and it's quite rare, was pre-COVID. Now, we're not calling for any sort of a collapse like COVID. I don't think we can pretend to predict those things. We'll follow the data rather than forecast, but it is a notable divergence there. We measure volatility not only across equities, but bonds and currencies. And this is that all three wrapped up into one. And it's starting to perk up a little bit, a yellow light, not a red light there yet. Currencies, we look at a basket of risky versus safe currencies. That's starting to correct. Again, a yellow light, not red. The US dollar has kind of been stubbornly stuck in this range and is testing the upper end again. So if we break above roughly 101, not to stick a pin in it, but that would be a new high. In general, when the US dollar is rising, that's risk off. That would turn into a red light. The S&P, you can see, is still an uptrend. We rallied hard off that low in March, and we held that red line, which we were watching closely. That's 80 weeks or roughly 20 months, which has only been broken 10 times since the mid-1990s, if you recall. So the chart in front of us is correcting in a bull trend. You can see the first blue candle last week, so that just means you open near the high and close at the low. That is a change in character. It could be just a sideways movement, or we could blast off to new highs tomorrow. We don't know, but it is a change. And then if we zoom way out on the S&P and do a regression off of the 09 lows, it's still in a nice, healthy, long-term trend. But we did get quite close to the 2 deviation band here, which is around 7,700. A little hard to see perhaps on the chart. Can't zoom in here. We're strong but stretched in general. And these vertical lines, the first one shows December of this year, and the mean, if you do a regression, is only around 7,000. So maybe we're just a little bit over our skis from a big picture perspective. We still think the secular bull ends perhaps 2030 to 2035 as our base case based on demographics and prior historic bull markets, etc. But again, we tapped close to that top end of the range. Global equities, this is an equally weighted index of about 3,000 stocks, and it's really our favorite to gauge the health of the market. Did not make a new high, notably, and the S&P kind of blasted off, and has taken out its first line in the sand here. The blue line is 20 weeks or 100 days, and you can see the momentum has started to fade. So we're in an uptrend, but it's a slowing uptrend, and we're correcting. And the average stock, didn't do nearly as well as the S&P, as everyone knows. The TSX has an equally weighted index as well, and this made a very marginal new high and couldn't sustain it. We're testing that blue line, so still an uptrend, but a waning one. And you can see the momentum flipped negative. It's been falling, the upside momentum, since March, and that hasn't changed. So we need to see that turn back up to be more constructive. Breadth has been a bit of a conundrum, frankly. We hadn't seen any breadth thrusts off this recent move off the March lows. And now still kind of neutral on a lot of the indicators. Some of them have actually been improving of late despite the market correction. So that's interesting. This one here is just 4-week highs in green and lows in red. And we want to see this push up above 54%. This is not my test. This is a guy named Jeff DeGraff. We've mentioned before in the US, Renmac is his firm. This is his concept. You get this escape velocity, he calls it, when it gets north of 54. And we didn't reach that off the recent low. And the last time we had that was May of 2025. So it's a kind of a stale signal, if you will. And now new lows are starting to expand, 28% recently. Shorter term measures, the percent above the 20-day in red on the left and above the 50-day, they've actually been starting to turn up a little bit recently, despite the sell-off, which is, again, odd. So underneath the hood, market hasn't been as bad. It's really been tech kind of catching down to the rest of the market. But again, we didn't get these thrusts off the March lows either, where these indicators often get above 90%, and that was lacking off the rally. So roughly neutral on a lot of these things. And then similarly with the percent above the 200-day. The good news is on the sell-off in the spring, we didn't break. We held 40%. If we go below there, then odds are we're going all the way down to the washout levels below 15, which we saw after the tariff tantrum. Again, this is kind of stuck around neutral. This is the percent of stocks in the Russell 3000 making 52-week highs in green or lows in red, so not 4 weeks, 52 weeks in this case. More highs than lows recently. So the small caps are actually kind of digging in, things like regional banks and so on. Again, this bent and didn't break in the spring. If we get more than 10% new lows, that's a sign of trouble. Another breadth measure, this is the percent of stocks in a long-term uptrend in the S&P and a shorter-term uptrend on the right. Both are starting to actually inch up a little bit if you squint, but again, no impulsive move off the lows, and kind of odd given the S&P went way up here. Canada, the breadth is weaker. We track every day the number of stocks making 3-month highs, which are in green, versus lows in red. And you can see 2 pretty big red bars recently. And the net number, the green minus the red, and a 10-day moving average of that is the blue line. That has flipped negative recently, and that's a trigger to say the internals are weak, and let's wait for them to turn back green. So that's what we're waiting for to become more constructive. You can see when that has happened historically, the market has done better. That's primarily because of the weakness in gold. We saw yesterday 115 3-month lows on the right, and the highs are on the left. Mostly gold stocks, and also some materials, that's gold, some energy, but gold's been the sore thumb in Canada recently. Speaking of commodities, our breadth measure in blue is still quite healthy, 75%. That tends to track the economy, not surprising. So we overlay that with the red line, the US PMI leading indicator. Good news is that it's continuing to rise, and it's not as good as it gets. Early 21 was record high PMI, and that was the time to sell. You can see commodity breadth sold off after that. So there's more room for the possibility of an economic expansion, and commodities are generally healthy then. We rank commodities here, energy, not surprising, near the top, along with base metals. Some of them running too hot on a short-term basis, 26-week rate of change normalized, for instance. So energy 3.6 deviations above the mean. Oil has been settling down, and we'll talk about that. And gold keeps on going down the pack, the precious metals. The broad raw industrials index, which is things used in the real economy, they're all listed on in the box on the bottom left, is quite strong. So this is a good global growth proxy, and it's holding up right near the highs. So no recession based on that indicator. Oil, as I mentioned, has been sloppy, and this recent rally failed right around its 50-day, which is the blue line. And you can see it's been quite choppy. So, the strength of a market is based on the rally. This rally was tepid. We need to see it break back above that 97. If it breaks below roughly 85, that's a key level, and we think it's going to unwind further. So that's a warning sign for oil that is losing its luster. And within the sector, we're noticing pipelines doing much better than E&P stocks. That tends to be a warning sign for the sector as well. When the aggressive E&P stocks are doing better, that's a good time for the sector, but that's starting to flip. Gold is still unwinding these massive overbought extremes that we saw last year. So the weekly momentum indicators they hit extreme levels, frankly, in November of last year and kept on going. The last time we saw these extremes, it took gold 3.5 years to make a new high, and we had a 22% sell-off. Previously, I don't show it on the chart, when it hit an extreme, it took 1.5 years to make a new high, you had a 33% sell-off. The monthly momentum is just turning down, believe it or not. we had this big dark candle, a change in character of gold, similar to what we highlighted on the S&P weekly chart, but more extreme because this is monthly. And we've broken the 200-day, which is the green line on the right chart, for the first time. We broke the 100-day back here for the first time in the spring. And the weekly momentum continues to fall at actually an accelerating rate. So we're not, we don't forecast, we follow, and the next support is around 3,800. That would be the rising red line here. And if it breaks that, potentially down to 3,500. And we're certainly in this penalty box. We've got to prove ourselves and see if gold can hold here. We've been highlighting copper versus gold in red for many months, and that is starting to mean revert, and it tends to track the economy, the US PMI in blue. That is starting, and you can see there's still a long way to go potentially. The stocks, the copper stocks versus the gold stocks, have indeed started to mean revert. And the last 3 times, there was more to come on that chart. So that's our preference. Copper has been correcting recently, but it has come out of a big base. And roughly $8 would be the equivalent of 3,300 when gold broke out. And 950 would be the equivalent of 4,000. So the stocks are correcting as well, unfortunately. But on a relative basis, they're doing better. The copper versus gold stocks, that is. Turning to rates, and this is the biggest risk, we think, for stocks, and particularly growth stocks. The fact that the 10-year yield is in a longer-term uptrend versus a downtrend. So this is a quarterly chart. We've talked about this before, a sell signal in 1985, a buy signal in the middle of 2022, and very impressive that it worked off these extreme kind of overbought conditions by going sideways, not down in yield. So we think that's poised to go up. And the issue with stocks is that the correlation has flipped here. So this is the correlation between stock prices and bond yields. So yields up, stocks down. That's flipped negatively. It could be temporary. You can see we've had some of those in the past, but this was the big one post-COVID when inflation reared its head. And indeed, inflation pressures are building. If we look at the PMI prices paid data in the US, that's spiking. That tends to lead inflation. The raw industrials index, which we showed you, is very strong. That tends to lead to inflation and so on. So this is our biggest risk in our view. And the Fed is likely going to take away the punch bowl. So the 2-year yield in blue drives the bus. You can see the red line is the Fed funds target. Remember back here, Powell saying not even thinking about raising rates. 2-year blasted off, and guess what? We had a massive hiking cycle, tightening cycle. So, the odds are that the Fed right now, we're baking in the market 1.5 hikes. So the good news is that it looks like we averted a recession. The bad news is that rates are weighing on stocks potentially. Speaking of recession, no recession still based on this blue line. The hard data in the US is actually ticking up, and the PMI in black, and this red line is the conference board leading indicator, how people feel, if you will. A survey of the PMI would have said there was a recession in mid-22 that never occurred. What people are actually doing in blue held up nicely. No recession based on the labor market. It's actually starting to stabilize after cooling, not collapsing. And that PMI, again in blue, does support, big picture, a shift into beta versus quality, which is already well underway. You can see the red line. It's actually correcting now after a big run. But again, we're not at record high PMIs yet. Our risk appetite chart is still on a green light, still an uptrend. Sector rotation still favors cyclicals, but as we know, it's really been, this is our heat map of sectors. We're going to skip over that because it's really been all about the tech sector, kind of breaking away from the pack. And our concern there is that semis, the SOX index, on a longer term view here, the momentum is pushing up towards the levels only seen during the tech blow-off, and we know what happened after that. So still rising, that momentum, but really in nosebleed territory, off the charts, we say. And if we zoom into the shorter term, we had a big gap down on last Friday on quite big volume. Volume's picking up to the downside. That's not good. And the momentum on a daily basis did not confirm this high. So we always say it's like throwing a ball up in the air. You're still going up, but at a slower pace, and that's your yellow light. Next step is that you could go down. So high risk for these semis. And then if we look at the equally weighted sectors in the US off the March 30th lows, not surprising, in blue is tech. And at one point it was up 55%. Now we're up 40 roughly. So it's starting to catch down to the rest of the pack. The red line is the equally weighted S&P, RSP is the ticker. The black line is REITs. That's the only other sector off those lows that is outperforming. So, this is, I'd say, almost unprecedented other than the tech bubble. And it's just not sustainable. So, this is catching down. The good news is these guys aren't really falling apart. So that's why breadth is actually a bit better as tech is unwinding. The big picture, recall that we like this short versus long duration chart. So this is global energy and financials versus tech and healthcare. Notice that COVID low happened when the 10-year yield bottomed. And ever since, it's been grinding higher in favor of short versus long duration stocks as the rates are going higher. These are industry groups, ETFs, and looking at the tickers. And we want to highlight private equity again because they're still in the rain. Software IGV was in the rain along with them for quite a while. Thankfully, it's coming out of the rain. But that's a concern. The laggards, the culprits of a potential bear. We always want to watch those. So we will look at those charts of BizD, which has business development corps like Owl and Ares, still in a downtrend. The March rally off the March lows was quite tepid, and it failed at that blue line where it's failed in the past. So we've got to make a stand here. We don't want to see these things break down. And PSP contains things like Apollo and KKR. Also a fairly tepid rally, a bit better than the BizD, but it also failed at that blue line, the 20-week or 100-day. Not quite at the lows, but not a chart to buy. And the relative strength of these things is quite weak. So we might be hearing bad news to come, if these break down again. Our TSX 100 Sun Range charts, there's a lot of mean reversion. Firstly, in the weakening camp, all the gold stocks are there now. And importantly, they're not yet fully in the rain. So the tendency is for these things to rotate clockwise. Anything can happen. They can all just reaccelerate and go gravitate right back to the sunshine, but that's not your base case. Lundin is the weakest one. It was the strongest coming out of the pack to the upside a long time ago, a couple of years ago. Now it's the weakest. The other areas, uranium stocks are following the golds down. So our models kind of start to gravitate to the ones that are coming out of the rain. Things like software stocks like CSU or insurance stocks, Intact, etc. IAG and Manulife and Sun Life are here. The rails are here. These stocks, especially the CSUs and so on, were hugging that rain cloud for about 3 quarters, 9 months or so. They're finally starting to improve. So that's where our models kind of gravitate with the hope and the intent that they rotate into the sunshine. And these are quant screens that include fundamental momentum, where our models populate the portfolios. And that is that. So last month was decent, up 3%. The TSX was up 2.4. We still are focusing on providing a smoother ride, if you will. The beta since inception is about half of the market. The returns haven't quite caught up. Stayed we're up 32.4. The TSX up 38.2 since inception. But again, a much smoother ride. And given all we've talked about in this podcast, we have again clamped down on the beta and are quite conservative. We don't know if this is the start of a much bigger correction, but we're moving into things that are working on our models, coming out of that rain, and avoiding the ones in the weakening camp. So we'll leave it at that. If you have any questions, feel free to reach out on the market and so on. And if you're interested in the fund, David Jarvis at Corton, they're the PM at IFM. We'll leave it at that. Thank you.